Thank you so much, gentlemen, for taking time out. Let's start off then, Nitin, by talking about your Q3 revenues, because your revenues have been a bit disappointing this time around. Apart from the seasonality, what has been the other factor that hurt your earnings?
So I think this is kind of what we are calling the duality, in the business in Q3. If I look at the core business, defined as the whole applications, cloud transformation business, that is actually doing really well, both on a sequential basis, more importantly, even on a YOY basis. Our core segment, BFSI, continues to do well. Our new accounts continue to do well. I think what's really giving the muted outlook to the numbers from a Q3 perspective is the extreme weakness coming out of the cyclicality in the mortgage services line. Given the environment with the macro, that business has really kind of, in a way, reflecting what's going on in the current residential mortgage and real estate market in the US. And volumes have dropped off quite significantly, sharper than anybody expected. And that's really what's muddying the overall headline number. But if you peel the numbers and you look at the non-mortgage business, that has actually grown 15% YY. If you look at the pipeline, that has actually grown 27% YOY, 6% sequentially. If you look at the TCV wins at 401 million, this is the second highest TCV win quarter for us. A significant contribution from BFSI in there, and of course, BFSI growth is also fairly strong. So I think the nuance of what's going on in the macro impacting the cyclicality of the mortgage business is something that I want to call out separately, because that's really what's clouding the overall headline number.
Okay, fair enough. So, Nitin, I just want to understand that, the softness that you pointed out to in mortgage, how long will that trough last? And given the interest rates are likely to remain sticky, is that going to be a little bit of an issue?
So let me give you a little bit of context. If you look at the mortgage service line, it is right now comprised of three main segments: originations, both repurchase as well as new originations or first mortgages. That part of the business, the volumes have declined almost 80% YOY. And that is because, given the current 30-year mortgage rates running at 40-year highs, even though they've softened a little bit in the last few weeks, they're still running north of 6% and they're touched 7%. That basically means that buyers aren't really rushing to take a mortgage or buy a house. The second line of business is home equity, which actually did well for a period of time last year, primarily because housing, prices had gone up in 20 and 21 first half. And that meant that people were actually cashing in on the equity that was in their homes. Because the buying, purchase, and selling activities also come to a standstill, even the housing prices have started to come off a little bit, but that business is actually still fairly robust compared to YY trends. And the third piece of the business is the servicing business. I think that servicing business, we think, will pick up in the next quarter or two, given the fact that this logjam or lockup of the market will not sustain forever. You'll either have delinquencies forcing sale of mortgage loans. As that happens, that will open up service line opportunities for us. Very hard to predict when this cycle will turn precisely, but it's fair to say that the current seizing of the market isn't likely to sustain for very long. And given that the mortgage business is now less than 9% of overall revenue, I think we've already taken a large part of that brunt over the last 2 quarters. So I think there's definitely some silver linings. We believe that as we head into the peak of the interest rate cycle, the market will turn. But more importantly, even without the market turning on the volumes front, we still think there'll be opportunities for us on the servicing side.
Right. Now, Manish, let me try and put that question to you. I just want to understand, in terms of the outlook, what could the next few quarters look like? Will they remain soft?
So as Nitin mentioned, we are at already a significant trough when it comes to volumes. Whether it will mean a further decline from where we are, that probably will be very, very limited, even if there is some, given it is already a small part of the overall revenue. Whether it will start moving up and we will start seeing increased volumes, I guess that's very much dependent on how the interest rate moves and when it moves in the reverse direction. Our view is it's at least 2 to 3 quarters away when that happens. And when that happens, we will be brightly positioned to kind of benefit from an upcycle in the revenue coming from that sector.
So, Manish, the silver lining was that despite muted revenues, your margins were held on to. But would it be fair to say that at the band of 15 to 15.5% will be maintained by the end of the year, which is at the lower end of your guided range?
The 3 quarters of the year are already passed, and we have been at 15.3. So, it is fair to say that the full year will be around that number. Having said that, if we go back to the philosophy that we had articulated, we will continue investing for growth while maintaining margins in a narrow band. And remember, when we communicated the range of 15.3 to 17, that time we were at 15.25. And the concern was whether the margins will drop, just to signal that we are very confident to maintain the margins at these range. Uh, our 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 process of investments ensures that we have the flexibility to move in and move out, and hence when there is a need we can kind of pull investments out, and when we have the surplus we can make those investments back again. The good news is this quarter we had quite a few operating things that came into play. We have been trying to get our fresher engine working right, and we are at an all-time high in terms of fresher billability. We also were able to improve our utilization, which over the last 3 4 quarters were at an all-time low. Both of those combined with the improvement in the mix of revenue from on-site offshore gave us tailwinds in margin, and we were able to kind of manage all the cost impacts that came with the significant drop in revenues, and despite that maintain the margin at the 15.3% range. We are reasonably confident that as we have been able to do it in the past, we should be able to continue managing the margins going forward as well. As things become better and as the revenue scale starts coming in, there should be a northward bias to the margin.
Nitin, I'll come to you now, and I want to talk to you about deal wins. It continues to be robust, and that's despite so much that is being talked about clients' budgets and what's happening, overall recession, soft landing, hard landing. So give us an outlook. What is it that is Mphasis understanding of the situation? Should your shareholders, the analyst community, expect deal wins of above $400 million?
What we've done is we progressively moved the band of our TCV wins into a higher zone. And I think we were in the sub 200 range, a couple of years ago, and now we're in the 400 range. So given the strength of the pipeline, the fact that the pipeline is up 27% year over year, we do believe that the TCV wins are fairly sustainable. While client budgets may be, under a microscope, primarily because everyone's trying to prepare for what they think might be a tough year in the US and in Europe this year. I think they're still spending money in strategic transformation areas which they believe are good for the long-term shift of the tech stack. For example, almost every client we know of has a very strong cloud adoption program, mostly public cloud. So the work we're doing with hyperscalers is very handy there. They're all looking at using data strategically, modernizing the data estate, moving it to the cloud. And more importantly, they continue to invest in areas like cyber and customer experience transformation, because they are also, customer side is where they spend a lot of money in contact centers, and modernization of those using AI and conversational tools is also a fairly strong area of growth. So I think I wouldn't say that broad brush every part of the tech estate will see growth, but I think they are going to make focused, targeted investments in the areas I talked about. And if you play in those areas like we do, you'll continue to see deal wins play out in your favor.
Okay, gentlemen, we're going to leave it at that. That's Mphasis for you on the quarter gone by, but more importantly, future commentary as well, expectations. You heard what they had to say about deal orders as well. The stock trading in the red, down by about 2% as of now.